Home prices just increased for the first time in 8 months. Black Knight just released their monthly housing report data, and what they said is that in February of 2023, home prices rose by 0.16%. That might not seem like a big number, but the reason why it's so significant is because we have just seen home prices grow after we saw 7 months of home prices fall steadily. And why did home prices grow in February? Because people wanted to take advantage of cheaper mortgage rates. Let me read you a quote from Black Knight. What they said is that the purchase market increased when rates declined in the early part of the month, and borrowers were quick to take advantage of limited inventory. AKA, people saw in February of this year when mortgage rates fell a little bit, and they wanted to take advantage of the lower mortgage rates, which boosted demand to buy homes. More buyers than sellers pushed home prices higher. And the reason why this is big news is because the Federal Reserve Bank, our central bank here in the United States, is actively working to bring down inflation. And in their most recent meeting, Jerome Powell, who was the chairman of the Federal Reserve Bank, was essentially saying that the fight on inflation is about to be over because they feel like that they don't need to do much more to bring inflation down. Well, one of the biggest components in our inflation numbers is the housing market. And for the last 7 months before February, the numbers have been showing home prices not really increasing. In fact, home prices have been falling in many areas. Now, if that starts to turn around, because even today in April, we're seeing mortgage rates lower than our peaks. And we've also been seeing more people want to go and take advantage of these lower mortgage rates. But if we start to see a shift in demand where more people start to go out and buy a home and home prices start to go higher, that's going to put higher pressure on inflation. And if we see higher pressure on inflation, that's not good for the Federal Reserve Bank because that could push the Fed to be more aggressive to bring inflation down, meaning that could force them to make interest rates go even higher than what they were hoping for. And that could hurt the economy even more because the reason why we've been seeing the issues in the economy, like the banking crisis we've been facing recently, is due to the higher interest rates. And so now you're starting to see that breaking point that I've been talking about for the last 18 months or so, where something's going to break first, either inflation or the economy, and the Federal Reserve Bank is going to hope, and they are hoping, that inflation breaks first. But we're starting to see those little cracks in the economy, and this is where now, if we continue to see higher inflationary pressures, that's going to be very bad news for the economy, assuming the Fed continues their fight on inflation, especially now when you couple what's going on in the housing market with what's going on in the oil market, which let's talk about the oil market because I don't talk too much about that. Now, we did cover this all in Market Briefs, my free financial newsletter, which is why if you haven't joined Market Briefs yet, I highly recommend you do so. Market Briefs is my free newsletter where my team is breaking down what's happening in things like the housing market, the general economy, inflation, the stock market, the global economy, into a fun, witty, and easy to read email. It's completely free. So if you want to join Market Briefs, I got the link to how you can join down in the description below. So in the oil market, we have been seeing oil prices surging in the last few days because OPEC came together and they surprisingly decided to cut the production of oil. Now, OPEC stands for the Organization of Petroleum Exporting Countries, and it's an alliance of countries that essentially have the ability to produce oil. And just like with the housing market, the prices of an asset in the housing market, it's houses, here it's oil, is determined by supply and demand. And you have this organization of countries that essentially get to control the supply of oil because they have the oil, and so they get to decide when they turn on the oil pumps or wells and turn them off or not distribute the oil. And essentially what happened over the weekend is they decided, OPEC, that they were going to cut oil production by about 1 million barrels a day starting next month. And that means that we're going to see a lower supply of oil. Now, when you have the same amount of demand and lower supply, what does that do to price? Well, now demand is exceeding supply, which would push prices of oil higher. And the reason why that's important is because a lot of things are impacted by the prices of oil, not just your gas and your energy bills, but also the prices for things like your groceries. Because in order to get your groceries from Whole Foods or Amazon or wherever you shop, a truck has to deliver these groceries from the warehouse to the store. And somebody has to deliver these groceries from the farm to the warehouse. All these things require energy because now you're going to need gasoline to fuel that truck, or you got to fuel the plane. And so when oil prices go up, it's not just your gas price that becomes more expensive. The price of pretty much everything becomes more expensive because oil has a trickle down effect into all different parts of the economy. Now, again, this is hurtful to consumers, obviously, because now, unless you are invested into the oil industry, you're going to be paying more prices for oil. So you are just paying the price. But then, in addition to that, it's kind of a double slam to the inflation issue that the Federal Reserve Bank is working to bring down, because now we're starting to see this shift in the housing market. Is it going to be a more dramatic growth in housing market demand, or is it going to be a more short-lived thing? I don't know. Right now, mortgage rates are about 6.5%, which is quite a bit off of their highs. We're talking about a 30-year fixed rate mortgage here in the United States, which, if you keep an eye on the weekly mortgage numbers, we are seeing more and more people want to apply for a mortgage compared to, say, 3 or 4 months ago. So we are seeing more demand for mortgages today than a few months ago, which means more people want to take advantage of the housing market, more demand there. And so if we start to see home prices grow again, and if oil prices stay high, now you can start to see that double whammy on inflation, which would hurt the Federal Reserve Bank's fight on inflation. And again, this is lagging numbers because we're not going to get all this data for at least a month after April is finished. And that's when the Federal Reserve Bank will have to either make a decision of, do they want to be proactive of wanting to bring inflation down, or do they want to wait and see what's going on with all these different factors in the economy? And again, this goes back to, what are you going to do about it? How are you going to protect yourself? And how are you going to take advantage of opportunities? And before I get into that, let me read you this one line from Bloomberg, which talked about the oil prices and how cutting the production of oil will impact inflation. This is directly from Bloomberg. They said, costlier crude prices threaten to spur still elevated inflation, complicating the task facing central banks, including the Federal Reserve, to tame persistent price pressures, aka the higher oil prices are going to make it harder to control inflation, which again poses more pain to the Federal Reserve Bank. So something you want to be aware of over there. Now, again, what does this mean for you? Well, be prepared for anything. I mean, even this morning, I'm going to make a full video on this soon, but JP Morgan Chase Bank just released their annual report. And within that, Jamie Dimon had his own letter to shareholders, a very comprehensive letter. And there's a lot of things in there, so I'm not going to speak about all the things in there. But essentially, in terms of a recession and inflation, what he says is, we think inflation is going to be worse than what the market predicts is going to be. And we do think that there are higher odds for economic pain in the future, especially now because of the banking crisis going on. So what does this mean? Prepare. Take care of your finances, live below your means right now so you have extra cash put aside, but also cash to take advantage of opportunities. Like I've been saying, 2023 is not the year to finance a new truck. 2023 is the year to prepare your finances. That way you can protect yourself and capitalize on opportunities that will come your way. So be financially educated. There's a ton of videos on my channel that go over how to start investing, how to learn about investing, what are assets, how do you find a good stock, how do you invest in real estate, how do you start a business. Tons of videos on my channel. There are a lot of channels that talk about that. Go out and build your financial education. Secondly, prepare. Put aside some cash to protect you against an emergency, but also have cash aside to be able to capitalize on opportunities and be ready for anything. Because the reality is, when most things like this happen, the traditional media is in the business of getting you to feel emotions. And they want you to get excited and scared or panic. And those things can drive clicks. But the reality is, it's not going to make you money. And that's where now you need to be able to cut through the noise and understand that emotions don't drive good financial decisions. avoid the emotions, be able to read through the data. That's why I created market briefs, because you can avoid all the sensationalism and get the real data. But try to just avoid the emotion, understand what's happening. That way you can make smarter financial decisions and make decisions based on finances, not emotions, because when people are panicking, that can create opportunity. So keep an eye out for what's going on. We'll be keeping you posted here and on Market Briefs.